Well, the ReCM Global Fund invests predominantly in large global companies listed on recognized exchanges across all markets. The fund was founded in 2006. The fund's benchmark is the MSCI World Index and has nearly $354 million in assets under management. Linda Eedes, portfolio manager at ReCM, joins us in studio for more. Linda, let's look at this. And I noticed in terms of geographical allocation, I want to start with South Africa.
Right.
We're in there at 4%. And we had a conversation off air. That is platinum, isn't it?
It is indeed, yes. You know, there is the old adage of blood in the streets, and it's sad that that is the case with platinum today. But it's very much indicative of the tensions in the platinum industry. And we believe that the price is pricing in, further potential in terms of the growth going forward, and ultimately will prove to be a solid absolute value opportunity.
It's a big debate.
Yes.
Now,
look, I must say, I actually agree. I agree with Linda. Now, if you look at the platinum sector, luckily enough for platinum, there's very limited supply, and what supply there is controlled in very few hands. Now, unless there's a technological breakthrough, the world needs platinum. And in fact, going forward with all of the environmental legislation that's coming on stream, specifically in Europe, we're going to need more platinum. The problem is now is that 5 years ago, every person and their dog opened up a platinum mine. Now there's too much supply and demand, of course, because of the world situation.
Mines are closing down left, right,
That's
and
the whole
centre.
point. That's the whole point, is that they're going to restrict supply now and wait for demand. So you're going to get a classical story where as supply starts to fall, demand will more than likely pick up. But once again, in investment, it's a question of timing. So maybe that's my question to Linda. What about the same thing has applied for 6 months, it could apply for another year?
Well, you know, our focus is on generating real returns and protecting against capital loss. So we're always buying things that are trading at a discount to what they're worth. And if you want to buy high quality companies at a substantial discount to what they're worth, you've got to buy them when there's bad news around. And that's very much the case with the platinum industry. Often the problem is that they do get cheaper from that point onwards. And you unfortunately have to take that short-term pain because you know that there is a very good upside in terms of the long-term investment story, as you say. And a good example is, you know, we started buying Old Mutual in late 2008. And at the time, the share price was around R8.40.
It went down to 4 rand.
That's right, it halved to 4 rand.
Then it
That's
went
right.
to 20 rand.
And we bought it at around 8 rand when it was trading at a substantial discount. So in the short term, you can look wrong, and that can be painful, but we know that ultimately doing this consistently does generate good real returns.
Having spoken to Pete recently, I know that Impala Platinum is a big bet in your stable. Lonmin, how are you feeling about Lonmin at the moment?
Well, actually, our biggest holding on the platinum side is in Amplats, followed by Lonmin, and then lastly Implats.
So I actually got it wrong. It was Anglo Platinum that he alluded to.
Correct, but we do hold all three of the big platinum producers, and for the same reasons that Wayne talked about earlier, which is that the simple fact of the matter is that the three of them control 70% of the world's platinum supply, and that's not going to change overnight. And so the industry is going through tension, it's going through conflict, but capital will be pulled out of this industry with the mines going bang, the smaller mines, and ultimately that will affect supply. And you've got to think of the global cycle as well. That will ultimately turn. Yeah. Europe, automotive manufacturer, etc. We don't know when it'll turn, but ultimately that will happen at some point in time.
Now, Linda, you've obviously got a large amount of money in the US, and when you look at the US share market, it actually just looks cheap. You know, you're getting reasonable earnings growth. You had very low PE ratings, very high dividend yields, but the underlying economy is doing badly. Do you think the profits and or dividends are sustainable? Because they've basically, we've only got these profits because of cost cutting. Do you think it's sustainable? Will they get some headline growth eventually?
Well, the businesses, interestingly, that we're invested in the US have very diversified revenue streams. So they're not necessarily sourcing that revenue from the US specifically. Most of them are quite global in nature. So most of them actually have quite a significant portion of their revenues coming from emerging markets, in fact. Interestingly enough, a lot of those stocks that we bought because they were trading at substantial discounts to fair value and still remain at discounts, businesses like Microsoft, for instance, some of the pharmaceutical stocks, they have actually performed quite well over the last year for precisely the reason you're talking about, the high dividend yields. You know, with the search for yield, that's obviously made them quite attractive, but it's not why we bought them in the first place, and they still remain attractive to this day, the businesses that we're invested in.
Ichirizuka Master Fund is your top holding.
Correct.
Tell us a little bit more about this holding.
Right, okay, so the Chirazuka Fund is actually a small cap fund in Japan. We've actually taken a position in the fund because what happened was we identified this fantastic investment opportunity in Japan in that space of the market. It's very ignored, it's very unloved. There are over 3,000 companies which aren't even covered by any sell-side analysts globally, trading at substantial discounts to book value. Unfortunately, for those small cap opportunities, you need to speak Japanese. Obviously, we don't. And so we've partnered with the value firm Milestone Asset Management, who has a very similar philosophy, a focus on real returns and protection against capital loss, and that's how we're accessing that investment opportunity. And also, one thing to mention is what kind of often leads us to seek these investment opportunities is the fact that we have our own capital invested in the funds, and quite frankly, we wanted a piece of the action in that part of the market.
That's always a good selling point.
Yeah.
United States of America, from a geographical perspective, this is your biggest bet. Just over 50% of the fund skewed to the US. Obviously, it's pertinent given Jackson Hole. I know you ignore the short-term news flow, but you obviously are convinced of the health of the corporates that you're backing in the US.
Yes, absolutely. Our first starting point is to identify high-quality companies. Now, what do I mean by that? Those are businesses which have generated a return over the cost of capital historically, but we are able to identify a reason why they will do so going forward. Because that historical analysis is irrelevant if, you know, they have no barriers to entry and competition comes in and those returns sort of go back to around the cost of capital. So a lot of those high-quality companies have been US multinationals, which have been trading at substantial discounts to fair value. Some of the pharmaceutical stocks are examples of that, and some of the technology stocks, not the Apple, which is the popular flavor of the day, but the Microsofts and the Dells and those businesses which are seen a bit more as sort of old technology, but which are trading at substantial discounts to fair value.
Europe. What
Yes.
position have you got there, and what's your view? I mean, so much depends on the currency, but what shares do you own there, and are you positive, negative?
Well, again, we look at the negative news flow and identify businesses which will weather the storm ultimately and which will see through the cycle and survive. In Europe, we've got about 15% in Europe in total.
European Union.
Where are we investing? Again, here's where the contrarian nature of what we do comes into play. The businesses that are trading cheaply are the ones where there's negative news. So we've invested in a business called Carrefour, which is the second biggest retailer in the world after Walmart. They are a French business originally, but they actually have retailers globally and also in places like Brazil and China. Obviously, it's a dire story for a retailer in Europe today. But this business has significant market share in each of the markets that it operates in, and that's closely linked to long-term profitability. And we think that this business, which is trading at less than its property, less its debt, the share price is actually below that, is a fantastic opportunity today. Will it go down a bit further? Will it remain a fantastic opportunity for 6 months, a year, 2 years? Possibly. We don't know when the cycle will turn. We know it will turn, and we think this business will weather the storm. And ultimately, we're generating returns over far longer than 6 months, a year, or 2 years.
BP is also a big holding within the fund. Now, again, that obviously magnifies your contrarian view, and this is a company obviously that you believe is going to weather the storm and ultimately come out strong. What is it going to take to unlock that value?
You know, we don't actually identify catalysts as to what's going to unlock value. Often what makes something cheap can give you a clue as to what will unlock the value, like in the platinum industry, the platinum price recovering as a result of supply decreasing and demand increasing. That can give you a clue, but the catalyst, we don't try to identify that. With BP, once again, high quality company, one of the lower cost sort of oil producers, if you like, as opposed to a Sasol, which is obviously sort of expensive technology to actually generate that oil equivalent. And ultimately, once again, it's trading at a substantial discount to fair value, less substantial than it was, because actually it's performed all right. And it also has a good dividend yield, which is actually, interestingly enough, despite the negative news, seems to be quite attractive to market participants today.
Linda, other than the platinum, what other direct emerging market shares do you own in the fund, or do you try and steer a little bit clear of emerging markets and pick it up via the multinationals?
We have been steering clear of direct emerging market exposure for the simple reason that the price you're paying is factoring in a lot of the good news in terms of growth, etc. going forward. What we have done though is we have chosen to buy businesses which are cheap today but which are generating emerging revenues, like Coca-Cola Hellenic Bottlers. It's the largest independent Coca-Cola bottler. It's listed in Greece. Now that happens to be the case because it was started by a Cypriot family. It's 25% of the Greek stock exchange. Everybody who's thinking about short-term performance is not going near the stock for obvious reasons. Its biggest markets are Nigeria, Russia, Poland, Romania. It's essentially an emerging market investment. But the price you pay for that earning stream, that's the crucial thing for us, and the price is very low.